Welcome to Apyx Alpha, where we break down Bitcoin, preferred equity, and the rise of on-chain digital credit. My name is Pete Humiston. I'm founding contributor here at Apyx, and this is part 2 of our series helping market participants fully understand Strategy's STRC preferred equity. In my last convo with Dan Kang, we covered where Stretch sits in the capital stack, and today we're going to go a step further. We're going to be unpacking why Strategy has shifted its funding engine from convertible debt to preferred equity, and what that means for its long-term Bitcoin accumulation strategy. By the end of this episode, you're going to walk away with a clear understanding of not just Stretch itself, but why preferred equity is becoming the core engine behind Strategy's ability to scale its Bitcoin exposure. Enjoy. All right, DK. Well, welcome back. Super excited to chat with you this time around. Last time around we chatted, we were talking about where Strategy's Stretch preferred equity falls in the capital stack, giving viewers just a little bit better understanding as to what exactly preferred equity is. And so this time around, it feels like it only makes sense to contextualize Strategy's recent move into preferred equity by giving a little bit better understanding to the audience where Strategy came from, and that is from the converts that they did. So I think, first and foremost, worth calling out that Strategy did raise somewhere around $8 billion in converts from 2020 to 2025. Can you give the audience just kind of a quick update? Like, why did that playbook stop working? And then maybe you can just set the stage too by briefly explaining what exactly these converts are.
Yeah, it's good question. So convertible debt, very simplistically, you can think of it as the equivalent of senior debt or a bond, right? That just effectively has the ability for the bondholder to convert to common equity at some predetermined price, i.e. the strike price, right? And I'd actually reframe the question a little bit, which is I don't think the playbook necessarily stopped working. I think if Strategy wanted to keep leaning in on convertible debt, they probably could, but I will say the terms might look a little bit different than they have historically. So taking a step back, historically, one of the points Michael has made is that the volatility of Bitcoin made it so that they could issue convertible notes with, let's call it a 0% coupon, right? 0% interest rate, an exceptionally high strike. Why could they do this? Well, when you have a credit instrument or a debt instrument that is backed by a highly volatile asset, effectively what you do is you create an environment where all the convertible arbitrage traders who typically traffic in these kinds of instruments, they own the bond, they short the common, but that high volatility creates like this exceptionally high value on the embedded option. It's the only way Strategy could really get away with issuing this kind of instrument and paying virtually no interest rate while still giving said bondholders that optionality. And what happened simplistically since the early days in which they started issuing these instruments is that a Bitcoin's volatility profile has gone down. So I think at the time in which they began this strategy, a Bitcoin's vol was, let's call it somewhere in the 60, 70, 80 range, and MSTR common was typically amplified volatility on top of that. But, most recently, Bitcoin vol has been somewhere around the 40% range. In fact, what I used to tell people last year when we were going and raising money on the DFDV front was I would tell people that in 2024, a Bitcoin was actually less volatile than half of the Mag 7 stocks. All right. So what does this mean? This means that Strategy has had to evolve from a, call it low leverage, high volatility vehicle to a high leverage, low volatility vehicle. So then the question is, how much, do you really want to take on that much leverage as you transition to a high leverage, low vol vehicle when the principal either comes due and or because this is a convertible bond, you have to deal with the equivalent share dilution later on. And ultimately what the strategy team decided on was no, right? They didn't want to take on this form of leverage anymore, particularly as they had to take more of it on. They wanted some other, I'm going to say, structure or flavor of leverage that allowed them to take on more of this over time.
Yeah, makes complete sense. Something that's kind of widely misunderstood amongst other things as it relates to just Strategy's initiatives around accumulating more Bitcoin. But, one of the things that I did want to kind of just pick your brain on is that everyone talks about Strategy's maturity wall. especially that September 2027 window where you see a meaningful chunk of converts come due. Would love to get your take, how should investors actually think about that moment, not just as a risk, but potential inflection point for the capital structure?
Yeah, good question. So to clarify, I mean, again, simplistically with convertible notes, they either need to get repaid or they need to convert, right? It's one of the two. September 2027 actually isn't the date of the first maturity. I know that gets talked about a lot, across X, but it's the first put date that comes up. So they've got about $1 billion worth of notes that come due in September 2028, but the put date is September 2027. So a put date on a convertible bond is simply a date in which the bondholder, right, not the issuer, the bondholder has the right to demand early repayment of the principal from the issuer at a predetermined price, typically par, right? Par referring to 100 cents on the dollar. It's just a protection mechanism for investors. So if, the stock, in this case strategy, MSTR common, has underperformed and the conversion itself isn't attractive, the holder can simply put the bond back to the company, get their money back, right? Rather than waiting until the final maturity, which in this case is 2028. So for strategies 2028, convert specifically, even though the bond matures in 2028, the holders can force a repayment in September 2027. That effectively makes the bond a 2027 instrument from a credit or duration risk perspective rather than 2028, which matters for how you think about, I'm going to say, MSTR's refinancing risk and liquidity needs and whatever have you. So the good news is the conversion for these notes is actually $183 and change. So let's call it 15% higher from where we are today. There's quite some time to get there, right? So it's actually very realistic. It's not hard to envision a scenario where, they actually move well past that strike price and maybe the, the put date isn't as big an overhang as folks are necessarily, I'm going to say, concerned about. However, the next tranche of debt that comes due is the 2029 convertible notes. That's about $3 billion of value, and the put date is June 2028, so 6 months after the put date of this first tranche you were referring to. Those have a strike price of over $600. I forget where the exact level is. So that might actually be a lot to get over. So now you realistically have a scenario where there's about $3 billion of debt that needs to get repaid, particularly if the bondholders do exercise their right on said put date. So, again, to contextualize, strategy sitting on plenty of Bitcoin relative to the amount of maturity that is here, right? And I think there's certainly a scenario where by that point in time, depending on where their premium to net asset value is, they've raised substantially more cash, so they'll be able to meet said obligation. But that to me is probably the more concerning date, or the more concerning tranche, if you will, versus this first tranche, even though that date comes up sooner.
So the converts haven't necessarily created a problem, at least not in the way that I think the market, sometimes seems to think. But nonetheless, can you explain to the audience how has the preferred equity, stretch that Strategy's rolled out kind of solved for this maturity overhang that the converts have kind of created in a way?
Yeah. So again, converts create, as you've referred to it, some kind of a maturity wall, right? Fixed maturity date and or put date means, the issuer needs to refinance or repay at some specific moment in time, potentially into a bad market, right? Like, not difficult to imagine a scenario where maybe the put date was sometime this year, and I think the discussion on strategy would be a little bit different. Preferred equity is, by its nature, perpetual, right? So there's no maturity, there's no put date, there's no scenario where holders can force repayment of the principal, right? The liability never comes due. And this speaks a little bit to that, I'm going to call it blended nature of preferred equity, right? Where it's like not quite equity, not quite a liability that we spoke to last time. Importantly, too, the dividends are in many cases deferrable, right? Debt payments are not. So most preferred structures allow the issuer to skip or defer dividends without triggering a default, which I think is a pretty important safety valve that converts, and particularly the converts that Strategy has issued, certainly don't offer. But importantly, the preferred equity also matches the asset to the liability. So Bitcoin's a permanent hold in the treasury model. Perpetual prefers a, call it permanent mezzanine equity or liability, depending on how you view it, right? But the duration mismatch that converts actually create simply doesn't exist in this kind of model. And that's an important consideration as Strategy decides to take on more leverage in the coming years.
Makes sense. Yeah. I guess kind of shifting gears a little bit with every single new kind of innovation, and I guess just even kind of when the inception of strategies accumulation of Bitcoin, we've seen like a lot of, I don't want to say buzzwords, but terminology come out that I think really helps better contextualize like what is taking place. One of those phrases is volatility refinery. A lot of people have called strategy a volatility refinery. What does that mean, and how does Stretch fit into that refining process?
Yeah, it's a good question. And I think taking a step back, the idea here behind a volatility refinery is simply that different types of investors can stomach differing levels of volatility. I mean, I remember from my days in long short equity that pitching Coinbase was actually a difficult task for my portfolio manager, because he looked at the underlying volatility profile and he said, I don't know what to do with this in my portfolio. Like, I would like to own this on fundamentals, but it just trades around, it's too closely embedded or tied to crypto asset volatility for me to really have a place in a portfolio. So there are just like, there's a large cohort of investors out there who will not invest into something simply because even if the returns look great over the course of a 5 or 10-year time period, they have to stomach massive drawdowns along the way. And whether it's for explicit risk management purposes or mandates within their firms, they just can't participate in these instruments. So one of the beauties of strategy is that they offer what we've called different flavors of volatility for different investor types, right? So to benchmark again, let's assume Bitcoin has a vol of 50, right? 30-day realized volatility on an annualized basis of about 50%. If you think of MSTR common equity as amplified Bitcoin exposure, then it makes sense that MSTR common would have a vol profile of 75 or 100 at any given point in time, right? 50 to 100% greater than the volatility of Bitcoin itself, or what we might call like Bitcoin on steroids. But again, Bitcoin and MSTR common fit, I'm going to say, the appetite of a certain investor class. And there are a whole host of institutional investors and even, frankly, retail investors who don't want to stomach that type of volatility. So on the other end of the spectrum, you have the convertible bonds, which have exhibited some volatility, of course, because, again, the underlying capital that underpins the entire model is highly volatile. But he's effectively compressed it down to like a really the lowest vol version of Bitcoin you can imagine, and gives you some embedded option via the strike or convertible feature, gives you some kind of return via like a low single-digit coupon in some instances. But that is really for, I'm going to say, the type of investor who doesn't want to take on the risk. They want the downside protection. Maybe they want some of the upside, but they're not in it because they want to ride like a 30 or 40% CAGR and deal with the roller coaster along the way. So in the middle, you have what I think is sort of like the cream of the crop, which is the preferred equity. An instrument like Stretch is a fantastic example where when Stretch first started trading, you were talking about a coupon that, started at 9%, went all the way up to where it is today, 11.5%. And the volatility profile of that was somewhere around, let's call it 10 or 11%. So what Michael would tell you is he would say, we took the vol of Bitcoin, just 50, stripped it down to a 10 vol instrument, and we capped the upside because there's no convertibility feature, and we're paying you, a variable rate dividend that, again, has ratcheted up to 11.5%. But we strip the vol, we strip the upside, and we give you just like a steady compounding return. All of a sudden, that appeals to a pretty large swath of investors, right? Think about, Pete, you come from this world, like the Citadels and Millenniums of the world who, could never really deal with, let's even say, like a single-digit drawdown, and they just wanted the steady, like 5-10% year after year return, irrespective of what the broader markets were doing. And I think as a result of that, this really appeals to a large cohort of investors, right? Some who cross over into equity, some who are maybe more on the fixed income side. And certainly for your average credit investor, something that has a double-digit return on a credit instrument is like, typically you're having to traffic in junk for that kind of return. But the idea, again, behind the refinery is you take a highly volatile asset that you think is going to go up over time, and you sort of reduce or dial down the volatility and dial down the return profile to what investors would deem to be appropriate for their appetite. And you just offer those different flavors. And in this case, I think he's managed to cover his bases pretty well, offer something that is exceptionally high vol in like the amplified Bitcoin side. And you can take it even further with like MSTR call options, for example. exceptionally low vol on the convert side, and it's something that's sort of like right in the sweet spot with these variable rate preferred instruments.
Yeah, it's really remarkable. Strategy and Sailor have done an incredible job of taking Bitcoin as an asset and being able to spin up all kinds of flavor products for any kind of market participant. And, I think they deserve a pat on the back for that alone. But, as we just start to wrap up here, Stretch, like you said, is a product that does seem to cater to this new cohort of market participants that maybe strategy couldn't necessarily tailor to in the past. But what are people still getting wrong about Stretch? Is there anything that stands out that you're just like, man, like people are totally missing the mark on this front?
Yeah, there's a couple things that come to mind. The first actually is that I think there is a, how would I put this, like almost upfront gut reaction that people have when they look at the dividend and they say, well, the dividend is 11.5% and therefore it must be risky, right? There must be something here that is going to blow up because there's no way this is sustainable. And for me, that typically comes from a place of misunderstanding of why that yield exists in the first place. And again, if your digital capital that lies beneath a digital credit instrument is appreciating on average at a 25, 30, 35% CAGR over the long term, and stripping off a third of that for yield on a variable rate perpetual preferred is not unheard of, right? You just need that instrument to perform at that steady rate. And I think the reality is that a lot of folks who have been watching strategy over the years have certainly been, you get a cohort of crypto investors, a cohort of maybe like common equity investors. There are very few folks who sort of lie at the intersection of crypto, equity, and credit, right? There's like a very small subset of folks who I think have an understanding of all three, because when I saw this instrument, the thing that stood out to me was that it seemed almost analogous to, I mean, frankly, it is asset-based lending, right? And the comparison I've given to people is, for years when I was in credit, we used to underwrite loans for oil and gas companies, basically looking at RBL loans, reserve-based loans. And you would underwrite like what we would call the PV10 of the reserves, which is like look 10 years out at whether these reserves are proved and actually like able to generate cash flows. And it was a fancy way of saying, yeah, even though this oil and gas issuer today is free cash flow negative, and most of them were, we understand that over a 10-year horizon, this loan is underwritten by a commodity that should either be like stable in price, and even if it goes down in price, like you've got a lot of buffer and wiggle room. And again, for folks who follow credit and folks who follow credit in the energy space, this is not like people don't look at those loans and think, oh my God, they're garbage loans or anything like that. But we have that gut reaction with strategy. And I find it ironic because, of course, unlike oil, the price of Bitcoin has been up and to the right over the course of the last decade. And frankly, if you're skeptical about that, if you're skeptical about Bitcoin's continued price outperformance, then I think it would make sense you're skeptical about digital credit and Stretch itself. But for those who actually believe in Bitcoin, it's a pretty simple model, which is just underwrite continued appreciation in excess of the yield that he's promising to the pref holders, and you have no problem meeting your dividend obligations. And of course, on top of that, he's already set aside, in this case, 18 months worth of cash reserves to meet said dividends. So it feels really solid from a credit perspective. And I'd urge folks to just sit down and frankly write out all of these metrics by hand, right? Write down how much Bitcoin strategy has, write down how much cash they have, look at the notional, do the math on the dividends, and see that it's not, you don't have to assume anything heroic for this model to really make sense. And in fact, you'd have to assume something pretty catastrophic for the asset base to even come close to matching the liabilities. I think we spoke about this in the last video interview, but you'd need Bitcoin to be somewhere in the like 15 to 20K range before you even got 1-to-1 from an asset and liability matching side. And frankly, at that point, I don't think the crypto space is going to be talking about Stretch that much. We'll be talking about much bigger problems if we have Bitcoin back at 15K.
Terrific. Well, DK, thanks so much for coming on and talking a little bit more about the converts and following up with the preferreds. As you mentioned, I think people are kind of looking at Stretch and maybe a lens, a traditional finance framework that maybe doesn't necessarily make sense. Hence why we published the Satoshi grade framework, which, we'll actually get into in the next episode and, give our take as to what kind of credit rating you should give something like Stretch, all things considered. But we'll save that for the next episode. Thanks for coming on, and we'll catch everyone next time.
Thanks, Pete.
Thanks. See ya.